is value going to start outperforming growth? That's the question I want to answer in this research. So let's review some background. Growth stocks like Meta platforms or Facebook have outperformed value stocks throughout this decade-long bull run. But recently, value has outperformed growth. So has the market shifted to value over growth? That's the question we want to answer in this academic-style research. Here's a quote from Benjamin Graham. If we assume that it is the habit of the market to overvalue common stocks which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue, relatively at least, companies that are out of favor because of unsatisfactory developments of a temporary nature. Now, the important part, of course, is figuring out if it's a temporary nature. Most of the times when things are going bad at a company, people get scared that they're not going to get better. But an excellent quote there from the master, Benjamin Graham. So the value versus growth debate is endless. Value and growth styles tend to move in cycles, sometimes in or out of favor. So what is this thing called the value premium? It's the return on value stocks minus the return on growth stocks. And it varies across time and market, but generally has been considered that there's a premium that's placed on value. And that's really what Benjamin Graham is saying. So let me review our academic style research format. First, we ask a research question. Second, summarize previous research. Third, formulate a hypothesis to test. And then select a relevant data set, remove errors and outliers, formulate a methodology to test the hypothesis, present and analyze the results, and advise on how to apply this to improve investment decisions. So let's test these research questions. Is there a value premium? And is the value premium, if it exists, persistent over time? So what is the hypothesis? Well, the value premium exists across regions and markets, and it's persistent over time. That's what we think going into this. So the data that we're looking at is 28 years across regions and Asian markets. We looked at the period from December 31st, 1994, until basically about now, June of 2022. We broke the world into 5 regions: developed Europe, emerging markets, US, Japan, and Asia ex-Japan. We also considered individual Asian markets like China and Hong Kong and the like. So how do we calculate it? Well, we used MSCI's methodology that they proposed in 2017 paper. And in that, they described values characteristics are a book value to price. They're looking at that. They're looking at 12-month forward earnings yield, and then looking at dividend yield. All these things together identify whether a company is cheap or expensive, and what they're looking for is the ones that are the cheapest, meaning value. And what are the growth characteristics? Well, long-term forward earnings per share growth that people are forecasting, short-term EPS growth, current internal growth rate. Remember that internal growth rate is equal to the ROE times 1 minus the payout ratio. And that gives a little detail I put in there about how they're calculating that. Long-term historical EPS growth trend, and then long-term historical sales per share growth trend. Now, I will note that the first one is long-term forward numbers, and the second one is short-term forward numbers. That means there must be an analyst forecast to get forward numbers. So that, a lot of times we don't include something like that because that restricts the universe so that you can only do it with the big companies that have forward forecasts. But in this case, they are looking at, trying to do it across, let's say, the S&P 500 and others. And I guess that they eliminate companies that don't have a forward forecast. So, or I think what happens is that they set it to 0. They set that particular measure to 0 if it's not available. Now, they looked at we looked at the value premium for different time horizons using that methodology. Normally, MSCI will calculate everything on their own, but in our case, we took their methodology and we calculated it on our own. Now, a positive number, meaning above the line, means there was a value premium. And the larger the difference, well, the more substantial the value premium. So here we can see that there was no value premium in developed Europe and the US over the past 28 years. In fact, there was a value discount. There was a growth premium. But Japan has shown the highest value premium. So in other words, value stocks have outperformed in Japan over the 28-year period, and same with in emerging markets. In fact, when you look at emerging markets, you can say that maybe it's the case that growth just never really took off in emerging markets because they never really had standout companies like, let's say, Facebook as an example, that was making huge amounts of profits. So here we can see it in a table format, and you can see that if we look at the 10-year period, there was no value premium in the past 10 years for any company. That was all growth outperforming value. So growth stocks have outperformed in the past decade. Now in the past 3 years, value has outperformed only in Japan. And for world and Asia ex-Japan, it's almost been a wash since 1994. In other words, value outperforms sometimes, growth outperforms others. But most importantly, you can see in the past year, we can see a massive growth premium, value premium, meaning growth stocks have been crashing relative to value stocks. So that's telling us right there that maybe the regime is shifting and we should be overweight value stocks. So here we can see that value has outperformed in the past year in every market by a massive amount. The highest outperformance has been in Asia ex-Japan. So value has started to outperform in the past year. We can also see it here when we look at the regions. And now what I want to do is show you world. What we can see is there's recent outperformance in the past month, or past 12 months. Let's look at that on chart format. Here we can see that value dropped less when the dot-com bubble burst, and growth took the lead in 2019. The green line started to exceed the blue line. The green line is growth. Now, you may think to yourself, wait a minute, I thought growth outperformed a lot more. Well, remember, we're looking at world. We're not looking at U.S. Growth definitely outperformed more in the U.S. So let's put this same data on that's a cumulative number. Let's put it on a year-by-year number. And what we can see is that in corrections, stocks with high valuations get hit harder. In fact, in 2021 and 2016, they were the only years in recent years when value outperformed. In other words, so I'll just grab my pen here and I'll show you what I'm talking about. In 2016, which is right here, we can see that value outperformed, but just by a tiny amount. And here we can see that value outperformed growth just by a tiny amount. When that blue bar is above the line, it means that value is outperforming. So by a tiny amount, value outperformed, and by an even smaller amount, value outperformed. The red line is just the performance of the market. So we can see that the market was pretty strong in 2020, but value basically just barely started to outperform. So in years when world stocks fell by more than 10%, value beat growth. In other words, when people are selling, they're usually in a crash, they're usually selling the hot, sexy growth stocks. Now this implies that value could outperform in 2022 if you believe that 2022 is going to be a difficult year. It already has been from the start. Now let's look at the US. And here we can see again that value dropped less when the dot-com bubble burst. So we can see right here, the green line shows us that growth was performing really well in the dot-com bubble, but then when the dot-com bubble burst, growth ended up underperforming here, and value took the lead for a long time. And then it wasn't until recently that we can see that growth really took off. Now, let's look at that on a month-by-month or year-by-year basis, and you can see that value outperforms in market downturns in the U.S. also. In years when U.S. stocks fell by more than 10%, value beat growth. And in corrections, stocks with high valuation get hit harder. So now the markets have already crashed a bit already for the beginning of 2022. So the question is, are they going to crash further? If you think they're going to crash further, then you would rather be in value stocks. So this implies that value could outperform in 2022 if you think that 2022 is going to continue to be a difficult year. Next, let's look at value minus growth since 1994 by Asian markets. And here we can see the value premium in many Asian markets over the past 28 years. Well, what we can see is that the highest premium was in Singapore, China, and Malaysia. In fact, we have a table here that can break it down a bit more so you can see it country by country. In the past 10 years, only Singapore has had a significant value premium. Here we can see that value has outperformed in the past year. So we're just looking 1 year, and what we can see is Singapore obviously massive. The lowest value premium has been in India and in Thailand. Something about Thailand, it just doesn't seem to have that growth story. So here in the past 3 months, value has done poorly in Thailand. In fact, growth is starting to outperform a bit. And let's take a look at Asia ex-Japan. Value began to outperform in Asia ex-Japan after the dot-com bubble burst. And you can see the blue line, value, has been outperforming. And what's significant is that growth really underperformed in 2021. And this chart basically shows you that Asia ex-Japan never really had the growth spurt that the U.S. had with growth stocks. And we can see that value outperformed in market downturns in Asia ex-Japan also. So you can see that whenever the market goes down, the blue bar is above, meaning value outperformed. So that's, of course, significant market falls by more than 10%. Though this wasn't the case in 1997, but I would say it was kind of neutral on value versus growth. And also, in Asia, it seems like in 2022, value could outperform. All right, let's look at Thailand. Value began to outperform in Thailand after the dot-com bubble burst. And we can see that growth really never, it had some years that it outperformed, but it never really had sustainable outperformance. And you can see here that in Thailand, value tends to underperform when the market falls by more than 15%. So, though value seems to perform well in the recovery years following the market crashes. So it's a little bit different than what we're seeing globally. Now, we did a little study to try to understand what are some of the stocks in Thailand, since we're looking at that right now. What are some of the stocks that are value stocks based upon the ranking? And here are the 15 top value stocks. Now, you'll notice that some of the stocks that are almost always going to be value stocks are banks, BBL, KTB, TTB, Tisco, K-Bank, Bay. All of these are banks, and banks tend to trade at a low price to book value and a low PE. Why is that? Because banks have a lot of leverage, so risk can be high. So whenever you're doing a value screen, you can basically see that banks are usually in there. So what's the action? In the past 10-year bull market, growth has beaten value in most periods in the world, U.S. and Asia. In the past year, value has outperformed. Now, if markets remain down for 2022, it implies value should outperform growth. And finally, in Thailand, after big falls in Thailand, value has outperformed in the following years. So to go back to the question that we started, is value going to start outperforming growth? I think if you have a somewhat negative view on the market in 2022 and onwards, then you probably, based upon this research, would think that value is going to start to outperform growth. If you think that things are down for just a little bit and we're going to get a recovery in the market, you may think that growth is going to outperform value. This is Andrew Stotz of the Become a Better Investor community. Have a great day.